Good afternoon. It's Jeffrey Christian. It's about 10 minutes after 1 o'clock in the afternoon on Friday, the 29th of March. The markets are closed, but we're working today because we have just too much work to do. It's been several weeks, I guess, since we really have been regularly doing these. We've been serializing our Silver Facts and Fantasies video, which was 2.5 hours. Over the last several weeks, and we launched our Gold Yearbook on Tuesday of this week, and we posted a 90-minute video, which has a lot of details on gold supply, demand, above ground inventories, prices, and other aspects of the gold market. We posted that on Tuesday. It's on YouTube. It's 90 minutes, and it covers a lot of information about the gold market itself. Gold Yearbook is the Bible. This is last year's book. It's about 240, 250 pages, statistics, analysis, data, charts, and tables. It's really something that if you're serious about knowing about gold, you should read it. And it's totally unbiased. It's simply facts. As somebody who once lost a couple debates to me, gold conspiracist, said to somebody else, "Don't ever debate Jeff Christian. He just comes loaded down with facts and information." And that's what we do. Gold is at record prices. The market's closed today for Good Friday holiday, but gold closed yesterday at $2,254, a new record price for gold. Part of the increase probably reflected the role of gold open interest on the COMEX out of the April contract, which became deliverable yesterday, into the June contract. We'll see what happens on Monday when COMEX reopens, and on Tuesday when both COMEX and the London market have reopened, Monday being a holiday in British markets but not in the U.S. markets. Gold, as I said, is at record levels, and silver got up over $25 at the close. It has been lagging gold over the last month. Gold set 3 new intraday records during the course of March 2024. And that's a very important point because gold is setting records. Let's see if I can do this. These are the prices. Gold setting records in an environment of strong economic growth. We have strong real economic activity in the United States, in Canada, in Europe, in a number of countries. There are pockets of weakness, but the overall economic activity has been much stronger than a lot of people thought, than most people thought, than legitimate economists thought, and far, far, far better than the gold promoters who have been waving their arms and talking about an imminent recession for at least 2 or 3 years now. Got relatively strong economic growth, relatively high interest rates, although I would argue that there's a very gruesomely inaccurate perception of how high interest rates are, declining inflation, a record stock market, a strong dollar, and strong demand on a global basis for U.S. Treasuries. I'm going to show you charts on all of these things over the next few minutes. As I said, we just spent 90 minutes talking about the gold market on Tuesday, and the other aspect, that's the microeconomic gold supply demand issues. The other issues are the economic, financial, and political environment in which gold markets and other markets operate. I'm going to talk about that here because we think it's very important. Now, we have been expecting record gold prices in 2024 and 2025, and we've been projecting that for several years. But we were expecting the prices to be higher and stronger in the second half of this year compared to the first half. But we've seen this these record prices, and they reflect basically investment demand picking up from some sluggish periods. We've seen strong investment demand and record prices in a time of strong economic conditions. Now, a lot of people will think, well, that's counterintuitive. Gold is a safe haven. It's a portfolio diversifier. It's a way to preserve your wealth when currency markets are volatile and when interest rates are falling and you can't get returns there. All of those things that a lot of people misunderstand about gold would suggest that gold prices should be relatively weak now, but they're not. And the explanation for that is very simple. Right now, we have a period where people have been seeing relatively strong economic activity, declining inflation for about 2 years now, but there's a tremendous amount of concern about what's going to happen in the future. And so what you're seeing are people are wealthy. Hey, I have a lot of more money in the stock market now because the stock prices have come out of their doldrum and moved to record highs. I'm earning more interest on my interest-bearing assets, and I have a job, and my disposable income has actually been rising at a faster pace than it has for decades in many countries, at least in the United States and Canada and a couple other countries too. So people feel that they've been doing well economically, despite what they kvetch about, high inflation and all. Investors feel that they have a lot of money and they're worried about what they see on the horizon. So they are taking money out of the stock market even as the prices rise, and they're investing some of that in gold and silver to diversify their portfolio and to protect against what ultimately could occur. And that's very interesting because, as I said, we had thought that prices would strengthen in the second half of this year as the economic environment weakened. And prices have strengthened in the first quarter of this year as the economic growth actually has strengthened. So that tells you that you maybe expect even higher gold prices when economic and financial conditions turn more hostile toward consumers, investors, and other assets. Now, a couple of provisos. We're not talking about a collapse. We're talking about a recession. You have to get some perspective here. The world isn't black and white. It's shades of gray, right? We're talking about going from a period of relatively good economic strength to relatively weak economic contraction. We're not talking about the Great Depression. We're not talking about a collapse of the international financial system or the treasury or the dollar. Yeah, don't think in terms of collapse. Get some perspective there. The second thing is what we've been saying for about a year or so, I think now, is that politics, domestic politics in many countries around the world and international politics, and the stresses on societal norms that we're seeing in the United States, Canada, Europe, China, Russia, around the world, India. You have massive political and social problems that are probably even more frightening to investors and more potentially damaging to investors' wealth than are the economic and financial issues. So you've got a potent storm on the horizon, but put it into perspective. And then there's the gold market and all the conditions in it. Go watch Tuesday's video if you really want to catch up on that. I'm going to end this with a little lesson on putting economic realities into perspective and how not to be frightened by large numbers and how to respond to people who do not know how to read large numbers. But let's go through this. Excuse me. Interest rates are high. They're 5% higher than they were 2 years ago. They've kind of plateaued. There are people who keep praying that they're going to fall. We keep saying, don't look for lower interest rates. But the first point is at 5.2%, interest rates, long interest rates, 4.2%, are at the low end of what you saw from 1968 through 2000. So what we've seen, and what CPM Group has written about, is the three stages of interest rates. We had an interest rate environment that lasted from World War II into 2000. And that was characterized by interest rates of 5 to 10%, with spikes up to 21% in January of 1980. Then we went into this low interest rate environment after it started, really after the recession of 2001. Started to recover, but then with the Great Recession and the global financial crisis, 2007 through 2009, we went down to the zero interest rate policy, and it's been that way for more than a decade. We're now going into a third era of interest rates. It's not that we're going back to the prior 1968-2000 era of interest rate policies. We're going into uncharted territories. This is a new interest rate environment, and monetary policymakers, as well as everybody else, are feeling their way through it. And one of the worst things you can do is have a theory to explain it. You have to look at, on a normative basis, what's actually happening. Right? Now, people say, oh, yeah, okay, Jeff, the interest rates are low by historical standards, but the amount of debt that's out there is so high. It's never been this high before. So that makes 5% interest rates that much more cataclysmic than they were from 1968 to 2000. That comes up to my final issue, but it's not true. Yeah, we have to be careful not to be frightened by high numbers, big numbers. Global economic growth, these are our 10-year projections. We still have a recession that we're projecting late 2024, 2025. Then we recover, but the recovery, both in terms of industrialized nations and on a global basis, and in terms of the emerging and developing economies, the growth rate that we're projecting post-recession, 2026 through 2032, is our projection range right now. That growth rate is lower across the globe than it was in the period from, say, 1995 through 2020, really. So that's our view. The reality, we had U.S. real economic activity, real gross domestic product data come out this week, and you can see here, these are the levels of output. And, I can load you down with other charts, but I won't. But, one of the most interesting charts is manufacturing output in the United States, which is pretty high. And it's actually a multiple of what it was back in the 80s. It's not that America doesn't make anything anymore. It's that we make it with computers and machines as opposed to labor. So we've lost 2/3 of our labor, manufacturing labor jobs over the last 40 years. But our output of manufactured products actually has risen sharply over that period of time. This is gross domestic product, rising, and rising. This is the percentage change on a continuously compounded average, and you can see it's there. It's rising, and it's in line with the GDP that we've seen for most of the periods since 2000, except for those periods when we were seeing recessions. So GDP is actually at pretty healthy levels. The kinds of steady state growth that doesn't drive interest rates so high that it throws us into a recession, or it's not so low that we just fall into a recession, which is one of the things we've done in the past. GDP overall is good. Now, a lot of people are suffering economically, a lot of low-income wage people, a lot of people who have taken on debt and bought bigger houses than they should have, and bought bigger vehicles than they should have, and taken more expensive vacations than they should have. A lot of people are suffering that way, but overall, the economy is in relatively good shape. And I don't want to belittle the economic pains of people, lower income people, but I do want to put it into perspective compared to historical situations. CPI came out a couple of weeks ago. Yes, it's been down. Headline is lower, has been falling more rapidly than core, and that reflects the fact that oil and gas prices actually have come down relative to where they were a year earlier, more sharply than other prices. Core inflation has some inflationary problems, primarily housing and primarily services have held up stronger. But we have seen a steady decline in inflation over the last year and a half, and it is moving in the right direction. This is the same thing, CPI, but month to month. You can see that we had a spike up in January and a further spike up in the consumer price index in February. The Fed prefers to look at the PCE inflation index, and that came out today, this morning. And the PCE, Personal Consumption Expenditure Index, price index, rose 0.3% in both headline and core inflation in February. That was down from 0.4% for headline inflation in January and 0.5% in core inflation in January. So we've seen in the PCE, which is what the Fed keys off of more than the CPI, you're seeing perhaps a stronger disinflationary trend than you're seeing in the CPI. Again, lower inflation, relatively high interest rates, strong economic growth, and record gold prices. Record equity market, the stock market has been rising very strong. It's recovered very sharply. You can see that the momentum since 2020 has actually been higher, even though we had this extended period of consolidation, some people would call it. Other people would say, oh, this was a bear market. And if you remember back then, when there were gold bugs who were saying that the stock market was going to collapse and that this was the beginning of the collapse, and then it didn't collapse, it moved to new highs, and they're saying that the stock market's going to collapse again. But if you look at it, you can see that since 2021, the rate of momentum in the stock market has been greater than the stock market's rate of momentum from, let's say, 2017 through 2020. Not that I have a political vein, but I do like reality and I do like honesty. Speaking of honesty, the U.S. dollar is not collapsing. People are racing out of the U.S. dollar. In fact, they're racing into the U.S. dollar, and they're racing into treasuries. The amount of U.S. treasuries held offshore by international investors rose 10.5% in 2023 to a record $8.1 trillion at the end of 2023. Central banks and foreign investors are not dumping treasuries or the dollar. They're actually racing to them. And the reason is very simple. The U.S. Treasury debt is relatively less risky in the eyes of most people than are other debt. And while the U.S. federal deficit and debt has now risen to $34 trillion and is about 123% of U.S. GDP, that debt is still considered relatively less risky than all the other debt in the world, private and public. And if you look at total global debt, it's not 100% of global GDP. It's more than 300% of GDP. So the rest of the world, or the world as a whole, is in much worse shape in terms of its debt to economic output ratios than is the U.S. federal government. And as a result of that, you're finding investors around the world moving money into treasuries. Treasuries, dollars, and gold. Those are the places where you move your assets when you're worried. These are the safe havens, if you will, the portfolio diversifiers. This is where you put your money when you're worried about what's going to happen economically and politically. So it's not unusual to see the dollar and gold rise, and it's not unusual to see investors loading up on gold at the same time they're loading up on U.S. Treasuries. Yeah, simple economics 101. Speaking of gold, price seasonality. January, February, March tend to be the strong period of strongest fabrication demand and also some strong investment demand. And that tends to see the gold price stronger in the first quarter of the year. And then it tends to decline starting in April, which starts Monday, and getting most severe in June, July, and August. Expect that to possibly be present in the price of gold over the next 6 months, or expect it also to have a lot of contrary pressures because of events going on, specifically the U.S. election and the deterioration of civility in American society. Now, numerophobia. It's the fear of large numbers, and it really causes a lot of people to get things wrong. This is household debt in America, and it's skyrocketing. You can see how fast it's risen, and compare that increase to the increase in the stock market at the same period of time, right? But we've seen a very large increase, really going back to 1980, in U.S. debt and private sector household debt. And again, you have gold promoters saying this debt is unsustainable at 5% interest, and it's never been so high, and this is going to be catastrophic for the economy, and you better buy gold from me today, or buy gold from the guy who's paying me to tell you this. But now, this is the percentage change year over year in household debt. And you can see it's not nearly as scary as that high number. And in fact, it's been coming down for the last several months. And it's sort of in line with what we've seen for much of the last 40 years. So if you take that high number and you get scared by it, it's like $34 trillion worth of debt. Oh my God. Yeah, that's terrible. We've never been here before. Well, in terms of 120% of U.S. GDP for federal debt, we have been in 1947. And from 1947 until 1981, we reduced the amount of federal debt relative to global GDP. And we did that with fair taxation, strong growth, and other factors. It was only after the Reagan tax cuts that it started rising again, to be honest. Yeah. So if you think about that fear of big numbers, in 1979, we had $900 billion of federal debt and a $58 billion deficit, annual deficit. And there were people, including Ronald Reagan's campaign, say, this is unsustainable. We can't do this. The Treasury market's going to collapse. It's going to break under the weight of $900 billion of federal debt. Then you fast forward 40 years, and for 40 years you've heard that same siren song, and it hasn't happened yet. We've had some bad economic periods, usually followed by a recovery and a new expansion to better highs, right? And now it's $34 trillion, and you're hearing the same story. You got to put those big numbers in perspective. You can look at it percentage change year over year, and more importantly, you can look at it, this is consumer debt as a percentage of household disposable income. And you can see it's a fraction of what it was in the period 2000-2008. And it's sort of like close to the mean from what we've seen over the last half century. So you've got to put it into perspective. I've gone on longer than I wanted to. We did come out with our gold yearbook this past week on the 26th of March. There is a 90-minute video reviewing it and discussing the gold market on our YouTube channel. You can go see it. You can go to our website. You can go to our cpmgroup.com/store and you can buy the book. It's an ebook. You can download it immediately. 250 pages of data and facts and unbiased analysis. We're not paid by marketing groups to tout gold. We're paid by investors primarily, and producers and central banks and sovereign wealth funds. We're paid by groups that want accurate information and analysis on the gold market, the silver market, platinum group metals, base metals, specialty metals, commodities in general. We're paid to be accurate and honest and unbiased, not to promote and not to denigrate. Yeah, there was a time in the early 1990s when one group of people were saying that I was part of some conspiracy to jerk the silver price higher, and another group was saying that I was part of a conspiracy to suppress the silver price. They were both wrong. I don't need them. You can go to our website. You can read about our stuff. You can get downloads, free reads, reports that we do for ourselves, reports that we do for Monex and for Gold Bullion International. You can go to Bloomberg. You can go to LSEG /Refinitiv, and you can see similar reports if you're a subscriber to either of those data services. You can send us an email at info@cpmgroup.com and say, I'd like to get on the right side of this market. What can you do for us? And we'll talk to you. In the meantime, take care. Be good to yourself. Be good to people around you. See what you can do to help the world because, as I said, there are a lot of storm clouds on the horizon.